So we started this series by thinking about what the UN SDGs are and whether we should actually try and follow them. Part of that discussion, of course, made us look at the SDGs as either a moral framework or societal expectations and gave us good reason to at least consider whether we should just follow them blindly. Just say, for whatever reason you think you do want to implement some of the SDGs, we then saw how business theory can help us decide when we implement them, or perhaps more importantly, which ones we should actually implement. The reality is that business often falls short when implementing them. And I think that's because the idea of implementing aspirational goals runs into the reality of the world. And we're going to discuss a few elements of the reality of the world that limit or constrain the decisions that any business manager can realistically take. The place to start is by discussing this idea of a profit-purpose paradox. Once we do that, we can look at three market constraints that play a very big role in limiting what you can and can't do in terms of implementing the SDGs if you're a business leader. So I think the starting point is to recognize that when we're dealing with implementing moral or social issues within a business, we enter something of a paradox. Look, if an SDG obviously increases long-term profit, you don't actually need an ethical defense. It's just good business, so you'd do it. In essence, you'd find an alignment between all of the theories that we've been talking about so far. The real problem occurs when the SDG implementation doesn't line up with long-term profit. If there isn't any long-term profit, it actually challenges the entire basis of setting up a for-profit company. It challenges the very logic of the shareholder interest because some of the residual is actually being used in a for-purpose way rather than a for-profit way. Now, am I saying that companies can't do this? No, I'm not, because shareholders can agree to whatever they'd like to. But the question is, what have they agreed to? And I think that's the more important question around implementing something that's a social purpose at the expense of profitability. In reality, most of these real-world initiatives lie somewhere in between, in this uneasy liminal zone, on the border between is it profitable or is it not, where we can't truly know whether or not it's going to make us money, where we will get political disagreements, small p political disagreements between people about whether we should be doing it or whether we shouldn't be doing it, and where things can often be reframed purely as marketing. So being in this ambiguous zone makes the idea of implementing any form of purpose fragile and also negotiable. And that's something we see when we look at some of the market mechanisms that are involved. The first mechanism we should be aware of is Akerlof's market for lemons, and I think it has a huge role to play in SDGs, what we've come to know as greenwashing. So there was this economist, George Akerlof, who won the equivalent of the Nobel Prize in economics for this idea. And his basic insight was that markets can collapse when buyers can't tell good products from bad ones, when there's an information asymmetry between the seller and the buyer such that the buyer doesn't know the quality of the goods that they're actually buying. His actual example was used cars back in the day, back in the 1960s, and used cars that were no good were called lemons. And because a buyer couldn't tell whether a used car was in good condition or poor condition purely from looking at it, it meant that in essence, used car dealers could get away with selling bad used cars. And purchasers couldn't assess quality, so they weren't willing to pay a premium for good used cars because they couldn't tell it was a good used car. So in the end, even the people with good used cars had to sell them at a lower price. There's a collapse in the market. So how does this apply to the SDGs and sustainability? Well, really, when we're talking about implementing sustainability, the difficult measurement problem that we discussed right at the beginning of this series means that really often only companies know what their genuine SDG performance is. The outside stakeholders don't know what they're spending, how much effort they're putting into it. That means that there's an information asymmetry between the person selling you the message and the person receiving the message. And that invites greenwashing, making misleading environmental or social claims. Look, a simplified example might help us understand this. Imagine you're running a coffee shop and you decide that you're going to sell free trade coffee. Obviously, that's going to cost you a bit more. Why are you doing it? Well, you might think that you're going to get more customers, or you can charge a bit of a premium for that product. So that's what you do. You buy the free trade coffee, you begin, and hopefully it's successful. So more people are coming to your coffee shop, maybe even paying a bit more for the coffee. What does the coffee shop next start to do? They'll start to sell free trade coffee, right? And that's what we've seen, a spread of this idea of selling something like free trade coffee. But what happens if that coffee shop isn't as scrupulous as you and they're not actually buying free trade coffee? The consumer's never going to know, right? You don't know whether the coffee you're drinking is free trade. And so that competitor is actually going to have an advantage. They're going to be able to buy the coffee cheaper than what you are. And eventually, all other things being equal, they're going to win out. So that's the real problem of the dynamic. Now, look, I know it's misleading and deceptive conduct to sell something that isn't that. I get that. But what we're talking about here is the mechanism rather than legality. Clearly, you can take some initiatives toward the SDGs and still then proclaim that you're trying to implement them at super low cost compared to a different firm who is genuinely trying to implement the SDG. So that's the kind of mechanism that we're talking about. And I was just using the coffee example as a kind of hypothetical so you can understand the market dynamics in play. And we actually see this effect borne out again and again. Firms with poor environmental records increase sustainability communications by about a third following negative incidents. Firms embroiled in controversies are 2.5 times more likely to seek high-profile sustainability certification. The European Commission estimates somewhere between 40 and 95%. So a half to nearly all green product claims show some form of exaggeration. And 84% of the UNGC members claim some SDG action, but only 39% set any kind of measurable goals around that. Again and again, we see evidence that a lot more is said about sustainability and SDG goals than what is actually done. And I think it should cause pause to say, is that a better situation than actually just trying to make profit and align with the profitable SDG elements that your business can implement? When we have this pooling effect, when an equilibrium forms because we can't tell firms doing good SDG implementation with firms doing make-believe SDG implementation, when they look alike, skepticism rises everywhere. And genuine leaders, people who are really trying to do it, see diminishing returns. Akerlof's adverse selection at play. Bad ethics drives out the good actors. Imagine our apparel company from the last video reports carbon neutral cotton, but really only implements it, say, in one of 20 factories. Investors and the market will reward the announcement, irrespective of how widespread the implementation is. And this mechanism has effect even on our theories. For instance, under shareholder primacy, if the market misprices authenticity, then it allows the actors in that market to rationalize deception. If everyone else is lying about their sustainability initiatives, most people start to say, well, it's only fair that I gild the lily a little, that I big up my initiatives beyond what I'm really doing. We see that over and over, that effect, even down to, for instance, we know at universities, students are more likely to cheat if they know their colleagues cheat. This is a natural human reaction. In terms of stakeholder theory, the dialogue that's so important to stakeholder theory, the firm interacting with and respecting their stakeholders is undermined. There's false information being exchanged during those interactions, what some people would call ethical theatre. And creating shared value even suffers. It suffers because the market won't reward real shared value when you can't verify the value that you're actually creating. So this information asymmetry, this hallmark of the SDGs that they're difficult to measure, actually really has a large effect on whether it's even possible to implement them. The second key constraint that we run into is that market structure can make ethics or doing social good economically impossible. In near perfect competition, where there's very low margins, many sellers, homogeneous products, low barriers to entry, profits tend to zero. Margin compression means you've got no money left over unless every firm does it together. That's one of the reasons why when you really want change about these issues, you need regulation. If you can't afford to chase social purpose, you just can't afford to chase social purpose. And we know, for instance, that SDG adoption rates are about 76% lower in low margin industries compared to those with less competition and higher margins. Firms with profit margins less than 4% abandon more than half of their SDG commitments due to competitive pressures. So if we thought about that in terms of our hypothetical apparel company, if you were paying living wage costs of 25 to 30% higher than your competitors and the fast fashion rivals hold their prices down, your market share is going to be eroded. Management is eventually going to have to label the wage initiatives as a pilot structure and end it. They won't be able to remain competitive in the market. The final mechanism in play is actually more of a macro mechanism, which is jurisdictional competition and what some call the race to the bottom. When businesses can move, I think the financial terminology might be when capital is mobile, regulation is negotiable. What we actually find is that jurisdictions or governments compete for factories, jobs, head offices, and so they will often make promises to firms around the regulations that they'll put in place. What some would call a race to the bottom, as these jurisdictions lower their standards to be attractive to these businesses that are going to bring lots of economic benefit. Do we actually see evidence of this effect? Yes. For instance, 25% of emission reductions in developed economies are offset by the carbon emission transferring to weaker jurisdictions. So they're shifting the carbon emission, not getting rid of it. The International Labour Organization suggests that nations competing for manufacturing investment will cut their environment enforcement by about 15% and labour monitoring by 22%. So yes, jurisdictions do compete. Even in Australia we see that. I well remember when there was a competition going on for where Virgin Australia would put their headquarters, that governments were competing by giving special tax concessions so that Virgin wouldn't have to pay the tax that all the other businesses have to pay to encourage them to set up in the jurisdiction. And we could see that in our apparel example. If you set up some solar panels in Vietnam and then shift your supply to Myanmar, which maybe has cheaper wages and laxer oversight, you can report lower emissions locally, but overall globally you've just shifted them to a different country. There's a carbon leakage in action. These three forces, greenwashing, margin compression, jurisdictional competition, they're one of the reasons that we end up in the profit-purpose paradox. It's exceptionally hard to break away from these forces without some form of regulatory intervention. That means that any ethical decision-making within business isn't a free-for-all. It has to have disciplined clarity within the limits of the structure that we're making those decisions in. So you end up with a general rule set that makes sense. Pursue profit-aligned SDGs first, right? There's no conflict there. They're the ones we should be doing. Second, chase resilience-building ones. Chase ones that are going to make you a stronger company, even if you can't directly link it to profit. Finally, purpose-driven ones where they're possible, and it may not always be possible. To really implement the SDGs in full, it's going to require regulation, and not only regulation in a country, but collaboration. Without that, it will become almost impossible to achieve what's being asked. And the real question is, should we really be trying to hide behind narrative gloss, or should we be telling people the truth about what we can and can't do in business to implement the SDGs?